Advanced Financial Accounting. In this presentation, we're going to work a practice problem related to a consolidation where we're going to have a parent-subsidiary relationship, the parent owning 100% of the subsidiary. This practice problem will include goodwill, so we're going to have goodwill to deal with within the consolidation process, as well as the fair value being different than the book value for some of the assets, including, in this case, being the PP&E, property, plant, and equipment, or depreciable assets, and there's going to be an impairment of goodwill. So there's going to be an impairment process that we will be having to deal with. We will be recording this consolidation a year later after the purchase took place. So in other words, the purchase that resulted in the controlling interest happened, we're going to say in January. We're going to do the consolidation 1 year later. So we will have to be dealing with, of course, those income statement accounts, those temporary accounts activities as well. Get ready to account with Advanced Financial Accounting. Here we have our information on the left where we have P purchased 100% of S, P being the parent, S being the subsidiary, outstanding common stock on January for $109,000. So the purchase took place, we're going to say at the beginning of the year in January, consolidation taking place at the end of the year. You can see that because we will be dealing with these dark blue accounts, income and expense account, the temporary accounts down below with regards to the consolidation. Fair value of building was higher than the book by $18,000. So once again, if we were to say, now remember, now it's been a year later. So this is S's trial balance 1 year later after the point in time that the purchase took place. And if this were the trial balance as of the point in time that this took place, if we were to take the assets minus the liabilities, considering that would be the book value equal to the equity section, we would be comparing that, of course, to the purchase price. Now, we also need to think about, is there any of these assets and liabilities that would need to be revalued, again, at the point in time that the purchase took place, which was January. Again, this is a year later's trial balance. We're saying that there was one, right? The fair value of the building and the equipment was now changed or different or higher by $18,000. Now, we saw that in the past, but this one's going to be a little bit more confusing now because now it's been a year later. So we're going to have to put this on the books. And we're also going to say, hey, look, if I have to increase the building and machinery, then later on, don't I have to depreciate that difference too? So we're going to have to deal with depreciation related to that as well. So then we have the depreciable assets depreciated at 10-year basis. So that's going to deal with this kind of difference that we have now in what we're going to be reporting as the building and machinery for S on a fair value basis as of the point in time that the purchase took place, because we're going to have to now depreciate that difference. Then we've got the goodwill was impaired and has a carrying value of the $2,300. So we're going to first calculate what is goodwill. So we're going to have goodwill in the first place. Then we're going to have to think about, well, now the goodwill has been impaired. What are we going to do about that? And then we have the trial balance. This is the trial balance for P and S as of the end of the year. So it's been actually exactly 1 year since the point in time that the purchase took place. If we were to add this up just like we normally do, we're going to say, hey, here's P's trial balance, here's S's trial balance. First thing we do, just add them across. So here's the trial balance, putting them together. That's going to be our starting point. Then we want to consider this calculation of goodwill. So I like to do this little calculation and say, all right, well, the purchase price was for $109,000. If we compare that to the fair value of S at the point of purchase, then we can figure out basically the goodwill. Now note, I'm comparing this to the fair value now. In our beginning problems, I basically put book value here because the book value was equivalent to the fair value. Now we have two components that could vary things. One being the book value being different than the fair value, and two, something intangible such as goodwill being on the books. So we're going to say, all right, the fair value of S at the purchase, what was that? Now, in practice, how would you do this? You would look at S's balance sheet last year, when this took place, at the end of the last year, the beginning of this year, and you would look at, the fair value, what would be the equity section, assets minus liabilities at that point. In a book problem, they may not do that. If they gave us only this trial balance as of the end of the year, how can I figure out what the fair value of the books were, assets minus liabilities or equity section at the beginning of the year? Well, we could just look at the equity section because the common stock would not have changed. The retained earnings would not have changed because the net income the dividends have not yet rolled into retained earnings either. Therefore, the equity basically at the beginning of the year, which would have been the same as the equity at the end of last year, which is the point in time that the sale took place, is going to be the 51 and the 31, or in other words, the 82. Now we want to take that 82 and consider what has happened to revaluating some of the assets at the point in time a year ago, at the point in time the purchase took place, with regards to the fair value. We said that the 18,000, there was 18,000 increase or difference at that point with the building and the depreciation. So now we're going to say, all right, we had 82,000 book value, plus we said that there was a revaluation of one of the assets, which is 18,000 higher. So that would mean that the adding these two up, we get to 100,000. So you would think then, after revaluating all the assets and liabilities at the point of purchase, then the purchase at the point, and this is a year later, this would be a year ago at the point of purchase, you would have thought that the purchase price would be 100,000, but more was paid, 109. How could that be if we'd revalued the assets and the liabilities properly? Because there's something that's not on the balance sheet, that of course, goodwill. So now we have goodwill of this 9,000. So we're going to put the goodwill on the books. Notice that we're going to also say the goodwill had been impaired at the end of the year, having to deal with that. But don't get those two things confused. We're first going to have to put the goodwill on the books and then record the fact that it has been impaired. Okay, so let's go to our equity. Think about our equity method transactions over here. So remember, just like in the past now, we see that we have this on the books in the investment in S. So this is P's books. This investment in S at the 109,500. How did that get there? Well, the original investment for P in S was for 109,000. That's the cash that was paid. Using the equity method, we debit the 109 and cash paid 109. Then we see that there was income. You'll recall I'm going back to the prior slide for S of the 35,000. That 35,000 is going to be represented in P's books. So then we have P representing S's income of the 35, and so that's going to increase the investment. And then I'm going back to the prior slide. We know that S also issued 34,500 of dividends. Those 34,500 of dividends are also going to be recorded here, cash increasing the credit to the investment. So this number, and this number represents that 109 that is in the investment up top here, this 109. Can't see my cursor, 109.5. All right, so knowing that, let's take a look at our adjusting entries, or our elimination entries, I should say, or our consolidation entries. So I'm going to do this basically in one larger type of transaction this time, and that's going to be, let's just take care of what we know. So we're going to say, what I know is that investment account needs to go down. This 109 has to be removed. The equity section basically has to be removed. I know that this income in S basically needs to be removed. So let's think about those things and just construct one large journal entry to basically do our normal or bulk portion of this reconciliation process or elimination process. So I'm just going to take away the whole 109 right off the bat. So the 109 I'm going to be removing. So there's the 109 here. Here it is down below. It's going to be taken to 0. Then we need to take away the equity for S, just like we've seen in the past, 51,000 for the common stock. We're going to debit it then to remove that 51,000, bringing it back down to just P's portion. We're going to do the same for the retained earnings. We're going to debit the retained earnings for the 31,000, taking it off the books, bringing it back down to we're taking S's retained earnings off the books, bringing it back to what P had. Then we're going to take the dividends off the books for S. This is a debit. We then will credit the dividends to remove them, and that'll remove the dividends, bringing us back down to the 32,000, which is what is on the books for P. We also note that if we look at the income statement, income minus expenses is the 35,000 for S. That is duplicated because you can see it over here. It's being represented due to the equity method being used and P owning 100% of S at that 35,000. So we're going to remove that 35,000 as well. So that's got to go. So we'll remove that item, bringing it down to 0. Now, if we had our normal assumptions that we had in our more basic type of problems, this thing would balance out. It doesn't balance out here. Why? Because the normal assumptions before were that the purchase took place for basically the book value. There was no adjustment for the fair value, and there was no goodwill. We now have the goodwill and the adjustment for the book value versus the fair value of the building. So those are going to be the two things that we're going to need here to fill the gap to have our plug, basically, to make this thing reconcile. So we're going to say, all right, well, the building, we could see, and you'll recall that it was $18,000 higher, the building and the machinery. Again, in practice, we would have to say which building, which machinery, and have the subledger breaking this out. But in general, the accounts as a whole, we're going to say this needs to be increased. There's 18,000. We're still not in balance, and that's because we now need to account for the goodwill that we calculated. And you'll recall we calculated it in a prior slide, is that 9,000. So there's the 9,000. So now this thing's in balance. So this is the way I would typically construct one of the main kind of adjusting entry here. Is just with one big bulk entry. This whole thing kind of ties together here, right? So we took the investment off the books. We took basically the equity off the books. We took the dividends off the books. We took the investment from S. Those things are all things we know. And we know from the original calculation that we had when we looked at the goodwill that there was an 18,000 type of difference between fair value and book value we can account for now. And then, of course, the goodwill, that should basically reconcile all those core concepts. Here's the goodwill then being recorded. Next, we're going to be saying, all right, now it's been a year later, and we recorded or increased the building and machinery by this 18,000. Now, if you do that, if you say, okay, as of the point of consolidation or the point of purchase, which was a year ago, we're going to now increase 18,000 to the machinery and equipment because we're trying to put it basically at the fair value at that point in time, as if kind of like a transaction took place for a sale type thing. Makes sense. However, now we're going to have to depreciate that because that's what we do with machinery and equipment. So a year has passed. So if you're going to say that the machinery and equipment is higher by 18,000, we're going to have to record our normal journal entry with regards to that depreciation, which isn't recorded by S because that's not on their books on the book basis. So we're going to do our normal depreciation entry, which is debit depreciation expense and credit accumulated depreciation. And then for the calculation, we're going to simplify this. We're just going to say, hey, the calculation is 10-year property. So that 18,000, we're just going to divide it by 10 and record that 1,800. Again, in practice, that would be more difficult because obviously in practice, you'd be saying you got a lot of different building possibly, or more than one maybe, and more than one machinery and equipment. And we're going to need to assign the value to those pieces of machinery and equipment and determine their useful lives and all that kind of thing to determine the proper amount of calculation. So you can see in practice it would be more detailed than this, but in general, the concept is, well, now you've adjusted something that's depreciable, increasing it, and therefore you're going to have to go through the calculation of the portion of that will be depreciable, reflect that in the subledgers, and then the account or the transaction for it is pretty straightforward. It's just a normal kind of depreciation expense and accumulated depreciation expense journal entry, but getting this number is going to be the kind of the difficult part with regards to it. Then we're also going to do kind of our normal transaction, which is to remove the accumulated depreciation here as of the point in time of purchase. So that happened a year ago. It's been a year later. In practice, we would know what it was at the time of purchase, and that's probably where we would go. Book problem, that's been a year later, so how can we back into that number given this trial balance a year later? Well, we have the 24,000 here in accumulated depreciation. Depreciation expense being recorded is 10,000. So the difference being 14,000 is going to be our transaction. So this is going to be our standard kind of transaction we have seen in the past. That's basically removing the portion of accumulated depreciation at the point of purchase and netting it out against the books up top. So we're going to debit the 14,000 accumulated depreciation, credit the building and equipment for the accumulated depreciation as we have seen in the past. Now, the next thing we had was an impairment to the goodwill. So once we have the goodwill on the books, notice it doesn't just get depreciated or amortized in like a straight line type of fashion. So we're actually going to keep it on the books, but then we're going to have to decrease it if it's impaired in some way, which means we're going to have to test for impairment somehow, right? We're going to have to go through and test and say, all right, was the goodwill impaired? And then we got to test for impairment. If it is impaired, then we have to write it down at that point in time of impairment. So again, testing it, probably not, it's not as easy to do the testing of it. Once you know it's impaired, the journal entry is going to be pretty straightforward. So once you know that there's a problem with goodwill, you're going to have to take it down. So for book problem purposes, you want to know that those two things are different. We recorded the goodwill based on the purchase that took place. Then we have to test for impairment later on to determine whether or not there's a problem. And you can think of it kind of like the accounts receivable when you have the allowance method and you're testing the accounts receivable and saying how much of these are going to actually be collected. The calculation to know how much are actually collected a little bit more difficult. Transactions pretty straightforward because it's even more straightforward with goodwill. Up here you have an allowance account, but down here you're gonna just say, okay, now I'm just gonna write it down to whatever I think the value should be, the carrying value should be after that point. So that's going to be the process. Just note on goodwill as well, it may be kind of an abstract concept, goodwill, like where does this goodwill come from? It kind of makes sense when you record the goodwill, because if you have a market transaction, that's when you reveal that there's goodwill, which you can think of kind of like a brand name. For some reason, S, people are willing to pay more for S possibly than, just the net assets. They're generating returns higher than what you would basically expect, which typically would be trust, brand name, oftentimes a big component of that. And just note, if there's a consolidation that happens, it may be the case that P now, having control over S, what S does, they might just want to cash in the goodwill. They very well might just say, hey, we have investors that want money now. How do we get money now? You cash in goodwill. How do you cash in goodwill? You start delivering products or services that are inferior given what the reputation of S was before the consolidation, and therefore you get your revenue is going to be higher, but your goodwill, the reputation of the service is going to go down, which means short-term revenues are going to go up based on the and reduce costs possibly, and then the goodwill would go down. So that's one way. If you see a consolidation, it could be the case that P wasn't able to keep the standards of S, but it could also be the case that the investors in P wanted money now and they're cashing in the goodwill by not keeping up to the standards and products or services that were there in S. But in any case, we have to test for that. We got to say, okay, well, what is happening? We got to test for the goodwill and see if it has gone down. So if it's gone down, we figure out the carrying value, and then we're going to adjust it down to the carrying value. So in this case, we're going to bring it down by 7,000 or 6,700. We're going to debit, just a goodwill impairment, a loss, and then we're going to write down the asset, which is goodwill up top. So notice the way this will typically be shown in a book problem is they're going to say the carrying value is 2,300. That's what we determined it to be. Then you need to write this number down to that number. Therefore, you have to do a subtraction problem, 9,000 minus the 2,300. To get the amount of the transaction that you're going to be recording, which is going to be that 6,700. So then to write it down, obviously we're just going to credit the goodwill, so that's going to reduce the asset. The other side's going to go on the income statement, in essence, kind of like acting like an expense. It's the goodwill impairment or loss, and that's going to be reducing the net income.